Today, folks, what should be the most tumultuous market of the year is the stock market tends to absolutely get clobbered in October, followed by the epic Christmas rally. Only seems to be proving Meet Kevins of the world wrong with all those diamond hammers saying, F that, baby. We're diamond handing this market to all-time highs in October. Now, I don't know if that's true, but you keyboard warriors with your crystal balls will obviously let me know where the market's going down in that comment section below. As today, we review the spectrum of everything from dividend stocks to growth stocks and what I consider to be the most fascinating stocks to buy this October, with catalyst in between. So if you're on a path to financial independence, today I'm all one day retire early, go join me on that journey, subscribe, and let's get into this by first and foremost talking about where the attention has been this year, and that has been on Palantir, that has been on Nvidia, and these companies went so far to the moon this year that they might have been overpriced. Now, I have been saying that for far too long, and I've missed out on many of the gains that so many of you experience. So I am but one man, projecting my insanity into the world of finance. So don't take this as financial advice by any metric. I am just a clown amongst many of the finfluencer clowns out there. But you got to kind of start to realize that these things just went on such a historic run that so much of the future perfection has been priced into perfection. And that's why, even though Nvidia had the most blowout quarter we've seen and continues to blow it out, the stock just can't get it up. Not even those blue pills are going to help Nvidia here. I mean, they really have to continue to keep at a 10 out of 10 scorecard in what should be a pretty tough market environment. But I think you're going to do okay. You can just see the steam starting to get burnt out, even with these great earnings, right? And you can kind of say the same thing about Palantir. Now, Palantir just entering the S&P 500 here soon. Stock probably still has a lot of room to run to some extent, but you have to recognize that it's kind of absurd in its value. And this isn't where your attention should be as an investor if you are a growth-oriented investor. Now, you can call these growth stocks, but really what you're doing is you're just playing basically social arbs, as dumb money likes to call it, right? Like, these are social arb trades. The entire attention is on these stocks. Everyone and their grandmother talks about them, but that comes with a lot of risk, right? Especially with things like Palantir that need to start performing to perfection, which is something they haven't actually been able to do that successfully in the past as their growth was going down, but now we're turning it around. So we'll see if they can turn it around to an epic scale and actually justify a 200 times multiple that it trades at today. But again, guys, what ends up happening is you pull forward so much value, you could get stuck in these 5-10 year cycles like we've seen with some other companies like Tesla. We'll talk about it in a moment. I got no love, I got no hate for these companies. It's just my opinion that I've been so wrong watching the rally continue, and I could be wrong in the future. But where I think your attention should be, if you are a true oriented value investor, is going to be on stocks that have real growth potential with real value today, which obviously sits in the Magnificent Seven. And my two favorite stocks that continue to be in the market, which is Meta and Google. Now, Meta has kind of come out of its value territory, in my opinion. Google is sitting in somewhat value territory, and we can only really base that off historical averages, right? Like, if we take a look at Meta here, trading at a 29 times multiple today, that's actually pretty normal for its historical averages, which could be anywhere from the mid 30s to basically the low. It hit a PE of 12 in 2022, which is just mind-boggling. But historically, it tends to trade between, the mid 30s and kind of the mid 20s. So obviously that was the buying opportunity of a century, but those times have kind of gone past us, right? And the only good thing about Meta is that it's such a small company that it can kind of generate that revenue and propel itself. So it's been able to kind of sustain 20% growth rates, which justify those higher PE multiples, and will probably continue to, because it's a company that's really only generating $40 billion a quarter, which is insane enough. But when we compare it to the mega cap of Google, Google's growth rates aren't nearly as impressive, but it is trading at a much more favorable value than it typically trades at through its history. But we could argue that that value is more or less fair valued for where the growth sits today, because we're only getting mid-teen growth. We're not seeing the 20 percentile growth like we're seeing with Meta. So both these companies are playing at different scales, though, as well, because Google's generating almost twice the revenue of Meta. So these two stocks still sit out as the most intriguing to me, because they have margin expansion going on. They've got a lot of growth vectors ahead of them. I still like Meta more than Google, which is why the wife has a huge position in Meta over Google, but I still think these are the two most advantageous stocks in the S&P top 10, whereas companies like Tesla, again, are playing in the social arb trade of things. When we look at Tesla today, I'm shocked that it's trading in the 260s at a 73 times multiple. Now, keep in mind, we do have deliveries coming up Wednesday. I have a hard time believing deliveries are going to justify 70 times multiple. Maybe when earnings come out, if we continue to see growth in obviously their energy sector, that could really start to justify it. But the reason the stock's going up, and the reason we all know it's going up, is the robotaxi event that is coming up on October 10th, which honestly, Honestly, guys, I thought everybody that owned a Tesla owned a robotaxi. And this is what I keep telling you guys. I don't think they're introducing a wide scale vehicle for robotaxis unless it's for limited areas where you're not actually going to be able to turn your car into a robotaxi, which, everything about the way this is being advertised is already disappointing me a little bit. But what we do have to recognize is failing to deliver a 10 out of 10 will put Tesla shares under a lot of stress. And I think this is very true because the biggest problem is that Tesla had it coming. So to speak, by hyping the event throughout the year. Yet I've been watching the obviously self-driving videos nonstop, and it's almost there as it always has been, but it's not quite there yet unless it's in very limited areas, which is what I think is going to be announced. I don't know. We will truly see. This could very well be a sell the news event. We'll see if, don't count Elon out. He can blow it out of the water at any time. I'm just very curious, and I'm going to be watching this like a hawk, and this is going to be one of the most fascinating things to see in the coming weeks. Now, if we pivot a little bit, I want to talk about the sectors that have performed ungodly well for where they sit, because these sectors are boring, right? We're talking about like British American Tobacco. We'll talk about like Philip Morris and Altria Group. I think these stocks have been largely shuffled under the rug unless you're in the dividend community, but I don't know if these are defensive plays against what could be a potential tumultuous market ahead, if that's what people are thinking, because it's very unusual for these stocks to do these kind of run-ups like this the way we're seeing them today. Because again, Philip Morris just skyrocketed to all-time highs. All these stocks just out of nowhere excelled for God knows what reason, right? Which means we're starting to see a bit of a pullback, which means that run was very exceptional for the sector they sit in, and now there's some profit taking. I'd love to know what you guys think about this sector. I think it's a good retirement sector if you're young, with the constant shifting and landscape of the sin stock sector and how people use these products. I would avoid it personally, but if you're closer to retirement and you want income, these are still going to be around for decades to come, right? I just don't see there being massive growth potential yet. I've been proven wrong. Look at the growth we're seeing in the stocks right now. I'd rather, honestly, and I'm pivoting to continue to watch the banks with excessive focus in the Canadian sector specifically, because the Canadian banks right now are starting to go back on a tear too, right? Like, these are considered somewhat defensive plays in more tumultuous markets globally. Canada has the most recognized banking sector anywhere, though Canada's GDP is stalling out and it looks like we are very likely heading into a recessionary period. I'm very curious to see what happens, because the banks can actually excel through a recession because their earnings have been a bit manipulated by loan loss provisions. They've been banking record revenue, and something tells me if things start to even out a little bit, even if the economy isn't heading in the best direction, so long as loans stabilize and everything starts to stabilize out, I think we could start seeing continued outperformance in the Canadian banking sector. So I'm going to be watching that like a hawk. Another fascinating sector to me has been Costco and Walmart, because these are, again, considered to be probably some of the most recession-proof stocks you could possibly buy. Now, keep in mind, that doesn't mean they're cheap. That doesn't mean you should be buying them. And I know a lot of investors out there have been pumping them for the resilience. And I'm really curious to see where the future of these stocks actually lays, because when you look at the growth, it is almost non-existent. And the reason people buy this is for the stability of the growth you're getting. But we're talking about mid-single-digit growth, right? Like nothing that excelled, especially when we look at the price to earnings multiple that continue to push beyond godlike levels. Like you can't justify, I don't know how you justify a 55 times multiple on a company like Costco that's growing in the single digit pace. And when you look at Walmart, Walmart also kind of growing in the same fashion, doing very well, from the revenue on the same, similar to Costco, yet trading at historically high multiples, even for the likes of Walmart. So I'm very perplexed. And again, this is all showing a sign to me that the market might be very concerned. Because these kind of what you would define as recession-proof oriented stocks have been really accumulating a lot of dollars without care valuation, or at least as far as I can tell. The market should be relatively efficient. You got to presume of efficient markets, right? But how do you claim short-term efficiency at such high multiples, in my opinion? Like, am I missing something here? Is there something you guys know that I don't? Keyboard warriors, let me know in that comment section, because it kind of comes down to, some stuff that's completely foreseeable. Like, look at oil. Like, if you're holding oil stocks right now, like I am, because obviously I have exposure to energy stocks, like, you have to understand that we're going to be seeing some slow quarters ahead of us. We are now sitting at lows that we haven't seen in years in oil, right? Like, we're kind of coming out of this highly inflationary market, and oil is no exception to that right now, with the supply and demand. Even though oil is seeing record supply, I mean, record demand, the supply seems to be keeping up with it no problem, right? So I'd be very cautious if you hold energy stocks. These are things that are starting to downtrend and are likely going to continue to downtrend with oil. Now, when it comes to my portfolio, obviously, like I'm still stuck to this three-fund strategy of VOO, SCHD, and BDY. Now, this three-fund strategy is giving me the exposure to the stocks that I want exposure to, and I don't need to buy them on an individual basis because, again, the wife does own some tech on an individual basis. I'm not trying to over-concentrate in any one sector. That's why I like these funds, because they give me what I need. Like, again, VDY for my financials, SCHD for some of those more recessionary oriented stocks that I think are going to be interest rate recovery plays. And then obviously VOO for those upper weighted tech companies that, you know, to some extent, some are overvalued, some are undervalued. There's going to be ebb and flow to that no matter what. But I do like this exposure that I get, and I think it's perfect for me and where I sit today. Now, obviously, I took the skin out of the game when it came to some of these interest rate recovery plays, because we're starting to see, you know, a little bit of a trend shift here. And I think, again, this could just be simple profit taking, followed by heading into the next interest rate cut that we see a bit of a bump. But my concerns lie in the fact that, history doesn't obviously perpetuate future returns. There's no past that represents the future. But typically we go into pretty dark months in October. And for the last several years, that's been true. And yet that hasn't been true this year. And I don't want to keep gambling on the fact with triple leveraged ETFs on the real estate sector, because this has gone on a historically crazy run into the first interest rate cut. And we could see a very healthy pullback that I don't want to be 3x leveraged for. So that's just kind of my thought behind V and Q. But we're still seeing some good growth in the individual REITs like O Realty. A lot of the Canadian REITs are starting to recover still, like RioCan, which I love seeing. I've been looking at a lot of the other stocks here in Canada, like TELUS, that should start to benefit off the continual interest rate cuts. We won't see the true effect of any of this stuff for quarters to come. So do keep that in mind, that the short-term rallies, again, are speculative, and they're kind of building in some of that pricing of what we should see as a return to cash flow. But I'm going to be sitting here patiently and just watching these. And these are great positions that me and my fiance all have exposure to. Again, I show you guys kind of a limited exposure to what's in my portfolio, but I always take into consideration my family's exposure, the wife's exposure. So remember, like, I'm going to be doing some courses down the road, perhaps some stuff that gives you more, light to how I manage these funds, the way I manage them. But for now, like I said, I think I gave you guys enough of a light into my personal investing strategy and how it's led to some pretty excelled performance. But now I'm very excited to see, with all the overvalued stocks, all the undervalued stocks, all these weird trends that are very peculiar against anything we've seen, where we go from here, guys. I really want to know. I wish I could draw a poll. Let me know in the comment section. You think, again, we're going to go into bullish territory continually from here, or bearish territory? The next earnings are going to be the deciding factor to this, and it's going to be very interesting to see. So I'd love to know what you think.